Matt, what's your word of the day? How do you see today shaping up? We had a lot of things happen yesterday, as I mentioned. Fed minutes, also the president-elect announcing that he wants to put tariffs on China, Mexico, and Canada.
It's a lot happening. I think easily I've got to come with a Thanksgiving word and gratitude. It's all about appreciating what you've got, family time at Thanksgiving, the lessons and mistakes from investing, and the wins we've had investing. But gratitude also helps us stay grounded in times like this and focused on the big picture, even when the market gets volatile.
All right, so you're trying to stay grounded right now. Let me talk to you about your expectations. First, when it comes to the Fed, we got the minutes yesterday, the Fed indicating that another cut's coming. How important is that to the markets overall and the rally that we're seeing?
Yeah, they're forecasting a 0.3% increase for the second straight month, and the 12-month rate's been frozen since July at 2.7, I think it is, and could tick higher. But the latest boost of inflation is hopefully just a temporary bump. Regardless, the Fed doesn't expect to hit its target until 2026. So we're showing signs of being stuck above that 2% target, even though we are making some progress.
So it sounds like you're a little bit maybe anxious about the PCE report. By the way, Matt, I wrote a story for CNBC Pro yesterday, how to play the PCE report if you think it's going to be hot or if you think it's going to be cold. In your mind, I just want to be clear. Do you think it's going to be hot, cold, inline? And how would you play it either before or after?
You can go both ways here. So inline, that's kind of what we expect. But if you're cooler, I know you just had a small cap ETF manager on. I mean, that's the direction we go in. The economy's primed for growth, and it could lead to continued to upward movement in the Russell 2000. But top line growth combined with hopefully lower interest expenses should push small caps higher into next year. A little bit hotter. You could play it on the Mag 7 side. I mean, they don't finance a lot of their operations through bank loans, so they're somewhat insulated on that end. But what we've seen, I mean, we've seen what they've done. We saw what they did throughout the year and through this high rate inflationary environment, and so that'd be the place I'd look.
Some of the traders and financial advisors I spoke to, they also mentioned the Mag 7 names along with Amazon and also TJX with the thought that if we get a hotter than expected PC report, that means that consumer spending is really strong and the consumer is really strong going into the holiday. Agree with that idea that even a hot inflation report isn't necessarily bad?
Yeah, absolutely. It's where 2026 is kind of their target, end of next year, to hit their target. So we've got plenty of time. So I don't think it's a rush for them to get to that number. But you mentioned TJ Maxx, the retail side certainly could benefit in that hotter inflationary environment, and it's a holding that we own in our dividend growth portfolio.
All right. I want to get to your pick for us today. It's M&T Bank. We're going to show the chart once again. A big bump since the election. You believe that it has even more room to run. Does that also depend on the idea that we're going to get rate cuts not only in December but going forward? Because that's obviously a big factor in the net interest income story when it comes to all these banks.
Yeah, that's part of it. Rates are part of it, but we're optimistic about fewer regulations and potential merger activity under Trump's term and his second term. So yeah, regionals are still actually, believe it or not, trading at an attractive valuation relative to the overall financial sector. They've got strong dividend yields across the board, but M&A activity should rise and larger banks possibly acquiring smaller ones. That's not the reason for M&T. We look at that, it's the second largest regional bank. It's the largest holding in the KRE, which is the regional bank ETF. It's had a run. It's up 65% year to date. So that's one thing we have to look at. But their earnings growth year over year is 15%. Roughly 2/3 of income does come from that net interest income. So lower rates are going to help, but they've got a really conservative book of commercial real estate business, primarily in New York.
Okay. We're looking at the dividend yield of 2.5%. Is that a factor as well right now with the idea that yields possibly could be going down? The tariffs might impact that, but we don't know if that's definitely happening. But the idea that yields are going down, does it make dividends more important?
Yeah, of course. And it's I say it all the time. We're a dividend growth firm is our focus. We can't ignore some of these other asset classes in that process. But yeah, of course, these regional banks, they're extremely strong dividends. They've increased it 3, 5, 10 year, 40% payout ratio. So there's a lot of room there.